Good morning, good afternoon. This is James Bogart, CEO and President of Bogart Wealth. Thank you for taking the time today. Just a quick introduction. Bogart Wealth, our core competencies are financial planning, investment management, tax optimization, and tax preparation. We do believe it's important to seamlessly integrate all of them together. We are what's called a registered investment advisory firm. So we're fully independent. Our clients' assets are held predominantly at Charles Schwab. We're managing approximately $980 million of assets. It's about 700 households. 90% of those are ExxonMobil. We are true fiduciaries for our clients, so we're legally obligated to put your interest above our own. There are 17 of us on our wealth management and planning team. We also have 4 as part of our tax planning team. We are hiring too, by the way, so if you have anyone who's interested in joining, we're delighted to talk to them. We have 3 office locations, one in McLean, Virginia, one in Houston, Texas, one in the Woodlands, Texas. And our mission is to help our clients achieve financial peace of mind by preserving and maximizing intergenerational wealth. Many of you have attended one of these before, but I do commonly want to reemphasize your kids and your parents could be some of the largest variables of anyone's financial plan. We've made it part of our firm's culture to give them access to certified financial planners. We know the impact that we can have when we start doing planning work early on. And many of you now that are kind of entering or getting closer to this chapter of retirement know some of the things that you probably would have done differently if you had addressed it or talked about it a little bit earlier on. One of the calls to action for many of these presentations that we do, part of our why is to educate and help give some valuable content, but also is to give you the opportunity to sit down and run your numbers. We do offer one-on-one financial strategy sessions, absolutely no cost, absolutely no obligation. It's part of what we do is the opportunity to get to know each other. Now, we also are offering other educational events that we do. And just like with this one, all of our events are recorded and we're going to put them on the website. So feel free, if you haven't been to our website, check out all the other presentations we've done. There's many on there now. But we do one on the retirement planning timeline, one on retirement income planning, one on Social Security and Social Security strategies, one on tax planning and tax planning strategies, one on estate planning and estate planning strategies, one on net unrealized appreciation and post-retirement income strategies. I am going to be doing an update on that one next week, by the way. We also have one on long-term care and long-term care insurance, as well as Roths versus traditional 401ks and IRAs. We have done different topics as well based upon things that people have asked us to talk about. Delighted to add a presentation or at a minimum, I'll add it to one of the existing ones. Feel free to let us know. So today, we're really going to talk about some of the retirement planning process and get into some of the things you need to be thinking about if retirement's coming a little bit sooner than you might have initially anticipated it to. A couple administrative items. I do have the question and answer box open as well as the chat box open. Please feel free, ask questions. I'm going to talk real high level about some of the things that I think people need to be considering right now in this environment. And then I'm going to get into some of the specifics. And obviously along the way, I'm delighted to answer any questions. And this is a little bit of a mismatch of some of the different presentations that we've done and trying to really be specifically focused on the topic of things you need to be looking at now. So we're going to talk about what retirement planning is, why you need to be looking at it, what's important to you, some of the critical risk components that we should be evaluating as part of a retirement plan. And then we're going to get into the planning process itself, where we're going to talk about some of the analysis components. We're going to talk at a high level, different investment strategies, some withdrawal strategies, and then some of the maintenance types of things. And then at the end, I'm going to get into some of the specific items with regards to the ExxonMobil plans. All right, so at the highest level, retirement planning itself, it's a process, not an event. And given the environment that we're in right now, if there's any one takeaway that anyone has from today's presentation is you need to put yourself in a position to be able to make decisions quickly. And I think that the baseline is having a plan. I encourage anyone that's talking to us, have your own plan from us. We're delighted to do it. It doesn't cost you anything. But also consider having other resources as well. Other advisors do plans for you. Whatever it takes to give you the comfort level where you're at today. If there's any course corrections that need to be made, let's make them. But be in a position to make decisions and pretty quickly. One thing I did find with the group back in July is there was a lot of folks that were surprised when those conversations were had with their managers. Don't let those types of conversations be a surprise. Be ready to make decisions and understand what your options are going to be. So that's where, the first phase of all of this is retirement planning analysis. The second phase is then understanding what investment options you have available to you, and then understand how are you going to convert all of your savings over into a withdrawal strategy? How are you going to generate that paycheck? And then lastly, once you're in retirement, how are you monitoring and reviewing and tracking success? And we'll get into some of the specifics there. So really first, why retirement planning? Really what we find is we need to have a plan because it allows us to be in a position to minimize risks that most retirees are going to address. We want to be able to make informed decisions around funding for your retirement, and then have estimates for expenses to help predict a more reliable income stream going into retirement. And then understanding withdrawal strategies and understanding how much you're pulling on your portfolio at different phases of your lives, and making sure that the money doesn't run out before you do. And then lastly, that's where we get into some of those maintenance components and reviewing and monitoring. But really to get there, we need to have an understanding, and you really need to have an understanding of that vision. What does retirement mean for you? Retirement, it's very much financial, but it's also emotional, and understanding how are you going to spend your time? What are the key components that are important to you? Now, some of the ones that we typically see, family. What impact is family going to have on your retirement plans? Whether it's assisting kids, maybe it's an ailing parent. Some of it's health, not only with you and your spouse, but is your plan to stay both mentally and physically active throughout retirement? Could you make any level of changes in current lifestyle in order to have a more fulfilling retirement itself? But then also, are there things going on now that could have an impact on retirement plans? Another one we talk about a lot is home. Is the intent to stay where you're at, or are we going to relocate and move to a different state? There could obviously be tax implications with that. Or is the plan to downsize or potentially even just buy a second home, and because now you have more discretionary time to be able to use more than one house? Lifestyle decisions, whether it's activities or charitable gifting, things like that. How are you going to spend your time? Some folks want to retire and continue to do some kind of work. Maybe it's consulting or going after a different type of fulfillment from a work perspective. That does have implications on a retirement plan. Obviously, hopefully we're making money, but in doing so, if that is the case, that'll have tax implications with some of the longer term tax discussions that we're going to be having as well. For some clients, a legacy discussion is important, whether it's philanthropic or with their kids. Are there different causes and things that we need to be planning for? And the reason that we bring a lot of these discussions up now is because they do have cascading effects on some of the future decisions that we're going to have to make. So spend some time on the front end and understand, because it also translates over into what you're spending. This was an interesting survey we did. It's actually a little bit old, but the data itself holds true. But basically, it was asking folks what are important goals that they have in retirement. 79% of folks said that they wanted a secure, reliable retirement income. 73% said they wanted income that kept up with inflation. 58% said they didn't want to have to worry about having enough money. 22% said they wanted to be in a position to help out children and grandchildren financially. 19% more time for sports and recreation. 17% for volunteering. 5% to go back to school, and then 2% to make philanthropic contributions. The interesting thing about this survey is the top three all have to do with money. So naturally, that's part of the retirement planning process. I had a question come in. I heard that when retiring and moving to a tax state, you'd need to stay in Texas about 6 months before actually moving to that tax state. Is that true? So the answer really is it kind of depends. It depends on your situation and what the tax implications might be of your retirement. I'm going to get into this one in a little bit more detail towards the end when I start talking about the ExxonMobil benefit programs. But the short answer is, in order to be deemed a resident of a non-taxable state. You have to not be in that state for 180, excuse me, not be in the state that imposes a tax implication for 183 days. So for example, Virginia and Texas. So in order for me to be a Texas resident, I have to not be in Virginia for 183 days of the year, as an example. I am predominantly a Texas resident, as you can all probably imagine, and there's reasons for that. All right. Now, when we talk about some of the risks in retirement, the key risks that we really talk about, there's several risks, but the top four that we talk a lot about is longevity, inflation, market performance, and then healthcare. So when we talk about longevity, it really is people are living longer. You know, for a couple the age of 65, there's a 49% chance that one of them will live to the age of 90, 20% chance that one will live to 95, and a 4% chance that one of them is going to live to 100. This comes all back into making sure that there's enough money to fund for all of your needs, even if you do outlive what you think you might do. The other one is inflation. You know, inflation is a really very real thing. Hasn't felt that way for probably the last decade. But if you look at history and look at it over a longer time horizon, inflation's very real. And I would also make the argument, given the level of stimulus that's been produced and all of the debt that's been accumulated globally, inflation is going to be a larger risk, probably not necessarily in the short term, but definitely over the next 15 to 20 years. I think that is something that needs to be managed. But just to quantify it, a 3% rate of inflation will reduce purchasing power of $50,000 to $23,825 in 25 years. And then when we talk about market performance, there's two aspects there, sequence of returns as well as volatility. So sequence of return are really talking about having low and negative returns early on in retirement, because that can be very detrimental long term. But then also volatility really is talking more about how are we going to generate the cash flow when the market environments are having those more dramatic swings. You know, and having to sell assets in down markets in order to replicate or produce cash flow, that can create significant strains on anyone's retirement plan. And then healthcare. This is actually really specifically talking about long-term care outside of normal medical expenses, but needing to have additional care to cover whatever your needs are. But healthcare costs are rising faster than inflation. In the last 10 years, they've almost been 3 times the rise of inflation. You know, and a recent study did show that a couple the age of 65 is going to spend approximately $230,000 in retirement to cover long-term care expenses. So making sure that we've got those addressed in your overall plan, I think that's an extremely important part of the overall process. And so we do need to rely on historical averages to help us with some of these things, whether it's your spending or family longevity, looking at returns relative to your comfort level with risk. Taxes, that's a big variable. We do know that at a minimum in 2026, they're set to change. There's a chance that they could, based upon the outcome of the election. Inflation, as I already mentioned, I think that's a very real risk. We want to model potentially using different scenarios for inflation. But the one critical thing we'll say is that there is no such thing as an average retirement. A lot of folks ask us, you know, on a relative basis, how are they doing, or what do we typically see? You know, sure, there are rules of thumb that we can follow, but I will tell you, someone's spending needs and their portfolio, those can be dramatically different just based upon even somebody who might have the same position within the company. Everyone's situation is going to absolutely be different, but it's important to have flexibility in there to adapt to the times for what you need now, but also what you're going to need in the future. And again, none of those are average. So we want to make sure it's important to understand what makes your situation unique. Prioritize lifestyle goals, but setting realistic expectations of how we're going to achieve them financially. You know, and how much income you're going to need. It's very common, and this is one of the commonalities that we do see, is that income is going to change. And we categorically describe households, you know, the first phase of retirement typically is what we call the go-go years. We're more active, we're still healthy, we're doing a lot of things. Now you have more time that you're wanting to do the traveling or different family elements that you weren't previously able to do. Then they start to transition into what we call the slow-go years, and then eventually it's what we call the no-go years. But this is where you're setting those expectations for expenses, and we like to define what's essential, which would be your needs, versus what's more discretionary, it's more the wants. but then also having budgets in place for the unexpected items that inevitably always do come up. And so when we talk about, lifestyle choices, essential expenses versus discretionary, essential expenses we would define as food, housing, healthcare, insurance. Those are the needs. Versus discretionary, it's entertainment, it's travel, it's gifting, it's country club memberships, etc. It's always very fascinating to see between a husband and wife who defines certain things as needs versus certain things as wants. And it can be different between a husband and wife. So it's an important conversation to have early on, but then also making sure that we have those budget components in there for the unexpected, because again, they happen. And then we want to make sure we're modeling all of this with inflation assumptions in there. Part of our planning process, we do break out healthcare and we do inflate them faster than just some of the normal expenses. But same goes if, for example, you have a mortgage. If you have a mortgage, typically the principal amount is fixed, that mortgage payment is, and then we'll inflate, for example, the tax and insurance component of it. And then understand your income sources. So Social Security, employer pensions, any type of personal savings and investments. But then maybe you have rental income or business and employment earnings in retirement at some point. And then use these to help build out the assumption. So when we talk about some of those income components, for example, there's Social Security. Again, we have a whole presentation on Social Security, but it was never designed to replace 100% of anyone's income. On the lower levels, if you're able to live on about $11,000 a year, it'll replace about 90%. But theoretically, it's going to replace none if you have unlimited income. I don't know anyone like that, but I'd love to meet them. But for the US median household, it does replace approximately 40%. For the typical ExxonMobil household, we found it replaces anywhere from 10 to 30%. Now, the pension program, now the same concept, it was never designed to replace 100% of anyone's income either. On the lower end, it's going to replace about 12%. So that's somebody who's retiring right at age 55 with 15 years of service. On the higher end, it'll replace up to 65% of someone's earnings. Now, the formula itself is actually relatively straightforward. It's 1.6 times your years of service times average pensionable pay. There's a Social Security offset, but that determines the single life annuity option. And then at that point, we're then able to back into other types of annuity options, whether it's the period certains or the joint life options. And then that also helps us determine what the lump sum value would be if that's something we want to consider as well. What we found is the typical career ExxonMobil household who's retiring at the age of 60, the pension program will replace approximately 50% of what their spending needs are. And so, conceptually, if you think about it, if you're retiring at 60 and you've got 50% being replaced by the pension, let's just say Social Security is replacing 10%. So that's 60%. I don't know a whole lot of folks that want to retire and drop their income needs or spending needs down to 60% of what they were spending while they were working. So that's where that gap needs to be made up for with different savings and investment strategies. And really, any plan, again, if the takeaway from today is you need to have a plan and you need to have a plan that's up to date to be able to make decisions, but any plan needs to be holistic in nature, understanding your cash flow needs, investments, risk profile, and be flexible to adjust for tax changes, law changes. We do believe in integrating estate planning as well into the overall planning process. As we're building out a plan, we also want to compare different scenarios. Typically, it's timing. Sometimes it's looking at pension versus lump sum and integrating that in. But we also want to stress test it with potentially some different spending scenarios. And then once we have that base level of planning in, that's where we really want to have integration of tax strategies and how to optimize and enhance the value by making some level of changes. One of the examples is looking at net unrealized depreciation. Again, I have a whole presentation on NUA. This is an illustration of one of the NUA analyses that we do for our clients or anyone that we're visiting and doing planning work for. And then we're then going to look at all of the different tax strategies, whether it's tax loss harvesting strategies, whether it's using Roth IRAs and Roth conversion strategies. Either way, having that base allows us to build on any type of enhancements and refinements that we should have, but it also allows us to be able to make quick decisions, because if the company were to offer some type of change or ultimately were to ask you to retire, we need to be able to move quickly, have a baseline level of plan, but also compare it to what it would look like elsewise if you were to continue to work, or other different scenarios that might come about based upon scenario that we're in today. So that's planning, and the key takeaway is have a plan. One other thing we want to talk about is really understanding investments, and the most critical part of any investment strategy is understanding how emotions can have an impact on anyone's plan. You know, what we find is fear and greed, they can be extremely impactful on someone's investment plan, and does typically lead to them buying high and selling low. You know, we as humans, we're wired backwards. We do things when things feel good and feel comfortable, and we react typically more adversely when things feel painful. And it's no different when it comes to investment strategy. So what we want to do is have a strategy in place that's designed to reverse that human psychology, build a portfolio that's going to help with protecting on the downside. We want to know where our paycheck is coming from. So protect those essential expenses with some type of foundational element, and then employ strategies that are going to help us with very volatile markets, whether it's on the withdrawal side or even when we have good market years. How do we make sure that we're not overextending what we're spending based upon the fact that we've just had a great year? Because inevitably we're going to have bad years as well. And how's the plan adapting to those types of scenarios? So when we talk about investment strategies, I'm going to talk very high level, not making a recommendation on any one of these, but the point really is to educate you on the options you're going to have. Now, dependent upon your specific risk profile, it could change what would be the tools that would be employed in order to execute in replicating that paycheck. So we're going to talk a little bit about annuities. We're going to talk a little bit about bond ladders. I'm going to talk a little bit about income-oriented investments. I'm going to talk a little bit about more of a fixed asset allocation model, modern portfolio theory. Some people call it indexing. And then lastly, I'm going to talk about a little bit more of a dynamic concept, and how that fits into an investment strategy. So with annuities, there's really three most commonly talked about types of annuities. And by the way, this is if you were to take your lump sum and go and invest it in annuity, not necessarily the ExxonMobil one. But first, I'll talk about fixed annuities. Now, fixed annuities, the easiest way to describe them is think a lot like a bank CD. It's a fixed rate of return, and all of the funds in a fixed annuity are held in one general fund. Now, typically we see longer time horizons on these. It might be a 5-year increment or a 10-year increment, but you're getting a fixed rate of return for putting money in a fixed annuity. And then I'm going to flip over to the other end of the spectrum, which is variable annuities. Easiest way of describing them is think of them like mutual funds. A lot of insurance salesmen like to position these as mutual funds with airbags, where they've got some kind of risk parameter in there. Now, the rate of return with these is going to be more market driven because it's going to be an investment portfolio. And with variable annuities, all of the investments are held in a separate account in your name. Now, right in the middle is what we call indexed annuities, and they're kind of a hybrid of the two, where, for example, you might select to get a percentage of market participation on the upside with some type of floor. So typically you're capped on the upside, but it does prevent downside. And dependent upon how much upside participation you want would also drive how much downside participation you want. So for example, there are fixed annuities that have zero downside risk, but you're going to be dramatically capped on the upside. So it's important to understand the nuances of those and be very educated on what you're investing in prior to actually making that investment. Now, with indexed annuities, these also are held in a general fund, not a separate account, separate in your name. Now, with each of them, you typically can add on income riders. There's nuances here. The big negative with buying annuities is the cost associated with them. You know, for example, a variable annuity structure, it's not uncommon to see them have a cost structure somewhere around 3% or higher per year. And so we are very sensitive on costs. That's typically the biggest negative I see with any of these types of annuity programs. Now, depending upon our client's risk profile, part of the conversation might be, instead of taking 100% lump sum, it might be that we consider taking a percentage of the ExxonMobil annuity program, if not all of it, the annuity program, if they've got other assets that they're used to be able to live on. And I'm not going to knock the ExxonMobil annuity program. I think that there are some concerns I'll talk about a little bit towards the end. The only criticism I ever give it is that there's no cost of living adjustment. And that's not necessarily a bad thing if you have a baseline level of income coming in, but you really need to understand your situation and it need to have other assets to be able to help fighting those future inflationary components. All right. Bond ladders. Now, bond ladders, this is where we're investing in individual bonds. I'm going to give a very basic illustration of a bond ladder, which is, let's just say we've got $300,000 we want to allocate to a bond ladder. And so what we might do initially is have 100,000 go into a 1-year bond, a 200,000 go into a 2-year bond, 300,000 go into a 3-year bond. As the 1-year bond matures, we go buy a new 3-year. As the 2-year bond matures, we go buy a new 3-year. As the 3-year bond matures, we go buy a new 3-year. The concept here is that we're going to live off the income and just continue to ladder it out. Now, the issue we've seen with bond ladders as of late is interest rates, as many of us know, are come down dramatically. And so for a lot of households on the fixed income side, it's very difficult to get enough income in order to be able to offset their expenses, or at least that portion of the portfolio. But again, in conjunction with everything else, it might be something to consider based upon your risk profile. So when we talk about yields and income, this is really talking about the cash flow that's coming off of an investment. So for example, bond ladders, we're typically seeing between 2 and 4.5%. Now, by the way, that 4.5% means that the average duration of the bonds is very, very long. So a lot of 30-year bonds would be in that mix, may or may not be appropriate for you. But then we'll talk about other types of income investments, whether it's corporate bonds, they're paying anywhere from 1% to 2.5%. Some flexible income types of investment structures, they're paying about 5.3%. Mortgage bonds are between 1 and 2%. International bonds right now are not really paying a whole lot, from 0 to 0.1. And then you can look at things like preferred stocks. Preferred stocks are paying about 5.35%. Royalty trusts, this is like limited partnership investments, energy partnerships, they're paying anywhere from 7 to 19%. Obviously, a little bit more risk there. And then even some high quality, big dividend paying stocks are typically between 3 and 7%. As many of you probably know, ExxonMobil's dividend yield's now up above 10%. I'd say it's a pretty decent probability that we're going to see a cut there. But point is that you can buy a stock that's paying a good cash flow strategy, and that could be part of the overall income discussion that we're going to have. Now, we compare all of this, for example, to 10-year treasuries, government notes, where 10-year treasuries right now are at 0.73%. I don't know a whole lot of investors that 0.73% is enough cash flow for them to be able to live. So we're going to have to rely on other portions of the portfolio to generate the income that they're going to need. So one of the strategies that we're just going to discuss a little bit is a portfolio that, this is one of the portfolios that Bogart Wealth manages. It's called Prime Income. It's a dividend oriented strategy. And the whole purpose of being in that portfolio is to consistently receive between a 4 and 4.5% dividend yield. But also we'd like to see some performance as well. But when we're talking about cash flow, for the longest time, this was a diversification option that we considered relative to ExxonMobil stock. Now, by the way, most dividend paying stocks this year are down. The market's not really a true accurate reflection of where most of the economy is. It's been very heavily driven by the technology stocks, and there's been a huge divergence between dividend paying types of investments and a lot of the technology stocks. But that said, it's important to understand the concept of diversification in conjunction with cash flow. Don't take this as a recommendation to sell the stock today. We're trying to illustrate the comparison as well, though. But on the left chart here, you can see the market value of ExxonMobil shares as of the end of 2019. So we obviously know the chart now going into 2020 relative to a more diversified portfolio structure. But again, most importantly, the whole reason that we go into these types of strategies is for cash flow. And so the right chart here is showing the dividend payouts. And this is going back to 2000, where a lot of folks say, hey, look, I want to own ExxonMobil stock because the dividend yield is as attractive as it is. Now, I will admit, in current environment, sure, it is. However, I'm anticipating that's probably going to get pulled back. If we look at a more diversified strategy, historically, that dividend yield has been growing at 8.2% a year. So that's not that bad relative to some of the other income options that we have. And I do think that one of the strategies investors should consider is a more dividend-oriented strategy as a portion of their overall structure. So just something to bring up, and this is one of several of the portfolios that we're managing. Now, when we wanted to talk a little bit about more of a fixed asset allocation approach, this is people call it indexing, modern portfolio theory. The concept here is that if you have a 100% stock portfolio, you're going to take on more risk, but you're going to get better returns. Whereas a 100% bond portfolio, you'll have less risk, but lower returns. The concept between the two is, as we establish someone's asset allocation, if we have a combination of both stocks and bonds in the overall strategy, we're going to get a more consistent overall return with taking on less overall risk. And that's kind of what we're modeling here. Here's a 40% stock portfolio with 60% in fixed income, 50-50, and then 60-40. And so the only criticism I have of an indexed approach or just a more passive investment strategy is they don't always incorporate cash flow strategies. So if this is a route that you're philosophically in alignment with and really want to go after just pure low cost and not necessarily thinking about actively managing or changing the investments, fine, but make sure you have a cash flow strategy to go along with it, because more often than not, that the modern portfolio theory strategies don't come after how we're going to generate that paycheck. So it's important to kind of incorporate that. And then the last strategy we want to talk about at high level is what we call dynamic asset allocation. And dynamic, if you think about it, we use the example of in the start of the 20th century, railroad stocks represented approximately 63% of the US equity markets and just 0.2% later. Russia, India, Austria, Hungary were represented 25% of the global equity markets in 1899 and less than 1% a century later. The point is that investments will change. What's working at one point in time won't always work in the future. And especially when we have periods of sustained drawdowns, we need to understand where we're taking risk. Is it invested in the most appropriate strategies? And so the whole concept with dynamic really is it's not timing the markets. Let's not be confused there. It's a process where we're following actual trends, not beliefs or predictions. We're looking at the flow of funds relative to how assets are performing, trying to factor in all types of externalities, whether it's geopolitical concerns, economic upturns, downturns, industry or sector opportunities or risk, how interest rates are changing, tax rates are changing, what types of implications those are going to have on certain sectors or certain parts of the market, and then ranking and scoring them all relative to each other to have alignment with those asset classes. And if you look at, we call this the periodic table for asset classes. It's somewhat hard to read, but you can follow the colors. And the concept here is that not in any one given year are you going to have every single asset class be the top performer. And so because of that, you want to have alignment and making sure you have a strategy that's going to incorporate your long-term risk components with the parts of the markets that are performing and then mitigate as best we possibly can on the areas that aren't. So again, I think this is just to illustrate the different strategies. Dependent upon your risk, we need to make sure that we're incorporating all of those in. All right, next up, let's talk about withdrawal strategies. And I apologize, I'm kind of moving quickly. I've got a lot of content I want to cover. But when we talk about withdrawal strategies, there's really three fundamental withdrawal strategies that an investor has available to them. The first is income only, which is where you're living off of income and dividends. And if that's enough to be able to cover all of your cash flow needs, great. It's probably the most conservative cash flow strategy there is available. The second is a bucket approach, which is where we establish specific portfolio structures for short-term needs, intermediate-term needs, and long-term needs. And then the last one is a more systematic approach, which is where we're taking a pro rata withdrawal from a very well-balanced portfolio. Now, I will admit I'm a little biased here. I really do prefer the bucket strategy and how we're setting up a client's asset allocation. And it's all driven based upon someone's comfort level with risk. This, when it comes to how we're generating the paycheck, I want to remove emotion as best I possibly can from future investment discussions. And so part of that conversation is let's know where your paycheck is. So have a structure in place for a certain number of years worth of your spending needs. So for a lot of moderate risk investors, you'll typically see 3 years worth of spending needs in a lower risk investment vehicle. I'm not saying cash, I'm not even saying purely in money markets, but lower risk, less overall amplitude. Have that certainty of where the cash flow is going to be coming from. And then the next tranche, which we're calling the intermediate term money, is in more income oriented investment structures. It might be some of those big dividend paying stocks, might be high quality corporate bonds that are producing a cash flow. The whole concept here is to replenish what we're spending on the first bucket. And then the last tranche is based upon where is our growth coming from. I do believe that every portfolio needs to have some component of growth within it, But again, what fills each of those tranches really is going to come down to your spending needs, your comfort level with risk, tax implications. All of those need to be incorporated as we're determining someone's withdrawal strategies. So in order to determine tax implications, we need to understand the taxability of the source. So for example, Social Security, 85% of it's taxed as ordinary income for most households. You do have the ability to have it be less if your spending needs are lower, but for most of the clients that we're talking to, 85% is treated as ordinary income. Pension and annuity income, interest income, as well as IRA and 401k distributions, those are all ordinary income. Dividend income, as well as long-term capital gains rates, those are taxed at capital gains rates. I'll talk about that more in a second. Roth IRAs, not subject to tax as long as you're over 59 and a half and you've had that Roth for over 5 years. Liquidation of any investment principal, also not subject to tax if there's no gain on it. So that then introduces this whole concept of ordinary income versus capital gains rates. So we know under current environment, ordinary income goes from 10% to 12% to 22 to 24 to 32 to 35 to 37. We also know that capital gains rates go from 0 to 15 to 18.8 to 23.8, depending upon your income level. This presents some planning work and some planning opportunities. So for example, if you're working right now, it's a high income year for you, or it's the year of retirement and you've got different taxable components that are happening, that might not be the year to go harvest big gains on stock positions. But if you know that the following year, you're going to be in a much, much lower tax bracket, well, that's an enhancement or refinement on a portfolio structure just by waiting. Now, that said, we also believe it's really important to look at tax loss harvesting strategies. Tax to us really is the number one way that we can really quantify enhanced value. We do know what the ultimate goal and objective is, to keep more money in your pocket, and deploying various different tax strategies is so important as to why it needs to be integrated in someone's plan. Tax loss harvesting is a great example of that. So if you've got some restricted stock that's at a loss, that's pretty much the case for everybody. But let's say you've got other parts of your portfolio that are at big gains. Well, maybe we look at a little bit of a rebalancing exercise where we sell some positions at a loss and offset some of the gains that we might want to take in order to be able to ratchet basis up on the things that have done well. Some people recently had a client who has a lot of Amazon stock, and they also have some Exxon. Well, let's look at selling some of the Amazon. Let's sell the ExxonMobil. Now, one thing to caution on with this is make sure that we're avoiding what we call wash sale rules. So you can't sell a position at a loss within a 31-day period of time and buy it back, or it'll disallow the loss. So it's important, if you're selling a stock position or ETF or mutual fund at a loss, make sure you wait 31 days before you buy it back. For anyone who's fortunate enough to receive restricted share grants, more often than not, those happen at the end of November, first week of December. Whenever a restricted share grant vests, that is considered a stock purchase. So if you're looking at tax loss strategies, let's make sure that we don't do it probably, I'm drawing the line in the sand around October 23rd. Don't do it between now and when those new restricted shares vest. Wait until the end of the year if you're looking at selling some ExxonMobil stock to do some tax strategy. So a little bit of a tangent here, but something I thought was important to bring up. When we talk about managing cash flows and distributions, a lot of times the conversations around which account do we pull from first. And so the general rule of thumb that we like to follow is, let's look at spending non-qualified or after-tax assets first. Let the qualified assets, that would be your 401k, it'd be any IRAs you have, which are growing tax deferred, let them continue to grow, and then transition over to tax-free. You think about it, you want tax-free stuff to be untouched as long as we possibly can. Let's not draw on it. We don't need to draw on it. Let it go. Let it continue to grow tax-free. Let's use the stuff that's going to create tax along the way first, then the tax-deferred stuff, and then let the tax-free stuff be the last place we pull from. Now, one thing to caution on is managing required distributions. So what required minimum distributions are, you might hear us use the acronym RMD. This is when you turn 72, you're forced to start taking a percentage of your retirement accounts out every single year. You obviously can take more out, but you want to make sure that you're at least satisfying that minimum amount. And if you fail to do so, it's a 50% penalty on any amount that you miss. A lot of our ExxonMobil clients, RMD management is a big part of some of that tax optimization work. If you're retiring at 60 and all of a sudden you're in a position where you've got non-qualified assets to live on for a few years, or you're spending really low relative to how much you've saved, well, the odds are at 72 and beyond, required minimum distributions are going to be very punitive for you. So I did include the RMD table in here because it's kind of important to talk about. There is a proposal to adjust the RMD table. This has been on the docket now for over 9 months, has not gotten passed yet, but the current distribution table actually has RMDs. If you're 72, you're taking out about 3.9% of your outstanding balance. And that percentage is increasing every single year to the point where you get to age 115, you have to take out 52.6% of your IRA account. I hope you live that long, but that's a punitive implication right there. For most of our clients in their 80s, this 5 to 6 to 7% number, that's where it has the most bite. And really, if you think about it, if you're being forced to take out more than you want to spend, it's going to cause your taxable income to go up, and it's going to force you into higher brackets. That's where looking at Roth conversion strategies once you've retired and you're in lower brackets makes a tremendous amount of sense. And that's part of the ongoing planning work that any advisor should be doing for you to help mitigate taxes, not only now, but in the future. All right, couple things to talk about in terms of that reviewing and monitoring process. So the way that we work, Bogart Wealth works, the plan is the epicenter and the baseline of a lot of the decisions that we're going to be making. And I do think that it's important, not only if you have a plan, but anyone that you're working with, they're constantly bringing that plan back up to help with incorporating some of the long-term strategy and decision-making that we're going to have to do. And part of it's going to be looking at assets. Are your assets higher or lower than we projected them to be? It's income. How much did you make? Did you have any unexpected cash inflows? It's spending. Was that in line with anticipation? It's very helpful to do that. Usually I like to look at the 3 years leading up to retirement of what your spending habits were. The challenge we've had in 2020 is COVID's obviously impacted the way that we live. People aren't traveling as much. Vacations haven't been spending as much. So 2020 might not be the best year to do an assessment of your spending needs. Look at 19, look at 18, and that's going to give you a better indication of probably what you're going to want to be spending in retirement. How'd your portfolio perform? Is it higher or lower than estimated? A lot of our clients have some ExxonMobil stock, and that can have a material implication on how their performance numbers look this year. How are your withdrawal rates doing? So one of the things that we're monitoring is what percentage of your portfolio are you drawing on? Because there's a direct correlation. It's a leading indicator to what the survivability of your long-term success of your portfolio is. How did inflation do relative to expenses? And if there's any types of changes to timing and retirement goals. So critical thing here, if there's any takeaway from today, you got to have a plan. Be in a position to make decisions quickly. Now, a couple other things specific to that we want to talk about today is ExxonMobil's discount rate. So discount rate for the first quarter is going to be at 1.25%. We are now starting to model the second quarter for the grandfather category. So this is anybody who was born prior to 1957. Then we also have the all other category. So anybody who's born 1958 or later. Now, we do send out weekly pieces on the discount rates to help our clients with tracking what discount rates are projected to do. We do them for each of the age categories. But the trend with both of them is that discount rates for the first quarter are both of them are still going to be at new historic lows. Now, for the all other category, the math is a little bit more complicated. This is anyone born 1958 or later. Now, you're going to follow 3 different segments. Segment 1, 2, and 3, they're modeling high quality corporate bonds. Segment 1 replicates short-term bonds. Segment 2 is intermediate-term bonds. Segment 3 is long-term bonds. And again, we are sending these out every single week. Now, the projection for the first quarter of 2021 is that it'll be at a new historic low. I'm modeling that it's going to go down by anywhere from 37 to 39 basis points. We are anticipating we're going to get the official numbers this Friday, the 16th. And as soon as we know them, we will send out an update as well to anybody who's on that distribution list. Had a quick question. With the second quarter 21 rate projected to increase by 0.1, do you expect it to continue to rise throughout all of 2021? That's a great question. And I wish I had the crystal ball on what discount rates are going to do in 2021. What we do know is that rates are at historic lows, and they've been mostly induced because of all of the stimulus and the activity of the Fed. The Fed has committed to keeping their target rate at 0% through all of 2021 and into 2022. They're going to let inflation go a little bit in order to keep stimulus in the economy. But most importantly, what the Fed has done is what they're calling yield curve targeting, which has been them buying high quality, lower quality, and even high yield short-term paper. And so one of the things you've seen just even this year, you can see segment one, which is supposed to replicate short-term bonds. It's gone from 1.9 to 0.9 down to 0.51. I mean, short-term paper has just gone really down, whereas you haven't seen as much on the intermediate and definitely not as much on the long term. But that's ultimately what's driving what we're targeting to be new historic lows for the first quarter. Now, based on your question, you're right. You've obviously seen the updated projections that we're now modeling, which is showing that there is projected to be a slight increase into the second quarter of 2021. Now, the one thing I'll caution on with this all others age group, anyone born 1958 or later, the discount rates are based upon the last 2 months of the preceding quarter. So October's movement, whatever happens this month, doesn't have a direct implication on what the discount rate's going to be. All it's doing is indicating trajectory. The second quarter of 2021's discount rates are going to be based solely off of November and December and what happens there. And that's why we're still waiting for the official numbers, because the official numbers are going to be coming out for September on Friday, which is what we have there. If I had to have a crystal ball, I do think that we might see a little bit of an erosion of rates starting to move back up, but the discount rate is only one part of this overall conversation. There's an emotional as well as a financial aspect with regards to the timing of retirement planning and optimization there. Don't let the interest rate be the only driver here, because I do think that ultimately working longer does mean more money because you're continuing to save, and most importantly, you're not spending on your portfolio. But don't let this be the only driver, but don't also ignore it either, because it is an important part of the overall discussion as well. And that's a great segue to talk about kind of the roadmap here. So part of our process is to be translators and stewards, hold your hand and building out that optimization of some of the critical execution dates. Any of you who've watched some of my previous webinars, I like to use the football analogy, but when retirement's in our forefront, we're in the red zone. And this is when optimization and execution is so important. We don't want to have any fumbles. We don't want any interceptions. We want to be executing flawlessly. And so this is just an illustration of somebody who has a January 1st, 2021 benefit commencement date and some of those critical dates. So the earliest that someone's eligible to request a package is 120 days out. You can do it anytime after that. You can do it all the way up to the day before. Now, typically, if you do it the day before, you're going to have delays. But 120 days out is the earliest. So September 3rd was the earliest somebody who wanted to go January 1st could request a package. You want to understand the three most critical dates, which is the last day on the payroll, first day of retirement, and your benefits commencement date. Now, those dates should all be reviewed by your advisor. Now, typically it takes them anywhere from 3 to 5 weeks to get the package. I know some people recently have told me it's taken 7 days. I also had one I did this morning that took 60. So everyone's situation is going to be a little bit different in terms of timing. That's why I do recommend getting the package requested as soon as we can, with ultimately filling in these appropriate dates. Now, everyone's package is going to be a little bit different regarding where you're at in the company, what your income level is, but the forms that you're filling out are going to be consistent relative to what path you want to execute on. So for example, if you're going to go 100% lump sum, you're going to need to do the lump sum annuity election form. You need to have the qualified rollover form. You need to do the legal statement of resident address verification form. You'll also want to do the direct debit form. If you're fortunate enough to have a supplemental pension or additional payments plan, you'll also want to do the supplemental pension, the non-qualified pension form, as well as the direct deposit authorization form. And then if you're going to do the annuity, it's actually a very similar sequence. We're going to do the lump sum election, pension lump sum election form. Then we don't need to do the rollover form, but we're then also going to want to do the address verification form. We're going to do the direct debit authorization form, authorizing them to put the pension in the checking account. We're probably also going to do the direct debit authorization from the pension form, which is allowing them to take your medical expenses out of your pension. And then you're also going to want to fill out tax withholdings. And if you have state tax withholdings, you'll want to have that adjusted for as well. We're happy to help. I think if you have an advisor, they need to know these plans. They need to know these documents. They need to know how to execute these documents, because these are irreversible decisions that we're going through. And your advisor needs to go through them with you. My firm and I, we've done hundreds of these at this point. I think it's important to make sure that you've got somebody who's helping with the execution here. Now, the most critical date of this whole process is when you get the paperwork back. Now, ExxonMobil Benefits is asking for 35 days prior to your benefit commencement date. So if you have a January 1 benefit commencement date, you're going to want to get the package back no later than November 27th. So just kind of think about the timeline there and how you're going to execute this stuff. Now, of the forms, there are going to be 3 that need to be notarized. If you do not have a supplemental, 4 if you have a supplemental. 2 are going to be by the participant, 1 by the spouse. All right. Now, with the January 1 timeline, you will see the check come right around January 1st. You're going to want to get it into your retirement accounts probably as quickly as possible. At that point, then you know it's in there and you're going to have the insurance components on it. After that is when you can have a discussion regarding the savings plan. Now, the savings plan, you're not obligated to take it out, but it's the earliest you're eligible to do a rollover of the savings plan is after you're officially retired. Now, with the savings plan, this is where you need to call Voya to have them execute a rollover. Now, this is another one of those things that Voya, like most, they're human, they make mistakes. Unfortunately, lately they've made a lot of mistakes. I'd say probably 60 to 70% of these calls have errors. I think it's extremely important to have an advisor who knows how to do these rollover calls and knows the implications of the rollover calls, and have them on the line, because the quicker we can identify those issues, the faster they get fixed. What I will say is the typical rollover call takes anywhere from 28 minutes to 3.5 hours. I did one yesterday. It took 2 hours and 45 minutes. So just be prepared to wait when you do those rollover calls. And that was because the representative wasn't able to get the NUA math correct. But I do think it's important to have whoever your advisor is on that line. All right. I wanted to open up the window for people to ask questions, because I'm sure there are lots of questions related to it. To start that, I wanted to come back to the question regarding tax and tax drivers. So if you don't have a taxable implication occurring related to your retirement, then the timing of relocation is not necessarily as imperative. But if you have a supplemental pension or an additional payments plan, or things with relation to your retirement that are going to be taxable, that are going to force you in a higher tax bracket, that's where the execution is going to become a lot more important. So those typically, you'll see those folks retiring in the first quarter. A lot of times it's because we don't want to have a lot of additional taxable income, but it also has a lot to do with, if they're going to relocate, making sure that we've got a clear understanding of what the timing mechanism is from a relocation perspective. Couple other things. We do have some upcoming webinars. So next week, I'm going to be doing one on net unrealized appreciation and post-retirement income strategies. On the 28th, I'm going to be doing one on why you should consider Roth conversions now, especially based upon the election. If we do anticipate 2021 will be higher tax rates, we might want to consider doing more Roth stuff this year in anticipation of higher tax rates, just a planning strategy. And then November 4th, I'm going to be bringing back and doing one on how do discount rates affect my ExxonMobil lump sum. And again, we haven't had any questions come in, so I'll just kind of wrap it up. But we do really appreciate the time. This is my firm and I's contact information. Mindy's going to reach out, or Sydney's going to reach out and follow up, see if you had any answering questions, if there's anything we can help with. Please, please, please take us up on the opportunity to sit down, run your numbers, understand where your situation is, put yourself in a position to make decisions quickly if something potentially is going to be coming. At the end of this, we are also doing a survey. Would love to get feedback on topics, things that we could do better, etc. You said this presentation is on your website. Yes, it'll be recorded and it'll be up on the website most likely tomorrow, latest Friday, but it'll be up there. Yes. All right. If there's any other questions, my email is just jbogart@Bogart-Wealth. But thank you again for spending a little bit of time with me. And please stay safe, stay healthy, and we're here if you need anything. Bye-bye.